Imagine reaching into your pocket and pulling out a banknote only to realize you have no idea whether it's real or not. Imagine that the piece of paper in your hand was printed by a drugstore or a railroad company or some tiny bank you've never heard of, sitting in a log cabin 200 miles away in the middle of a swamp. Imagine living in a country with no national currency, where every single town, every neighborhood bank, and every ambitious con artist with access to a printing press could manufacture money out of thin air. Now imagine that this wasn't some lawless frontier fantasy. This was the United States of America, and it lasted for decades. From 1837 to 1863, the United States ran one of the wildest monetary experiments in human history. There was no central bank. There was no federal oversight of currency. There was no uniform dollar bill. Instead, more than 1,600 private banks were printing their own money, pumping out over 7,000 different varieties of banknotes, each with a different design, a different size, a different color, and a wildly different value, depending on where you were standing when you tried to spend it. Roughly a third of all the paper money in circulation during this period was counterfeit. And the worst part is, even if you had a genuine note, there was a very real chance the bank that issued it would collapse before you ever got the chance to redeem it. This is the story of how America's money supply was hijacked by private interests. How a nation tore itself apart over who controls the power to print currency. And how it took the bloodiest war in American history to finally put an end to the chaos. To understand how America ended up in a world where banks could print their own money and nobody could stop them, you have to understand what came before. Because the free banking era didn't emerge from nowhere. It was born out of one of the most bitter political fights the young republic had ever seen. A fight that pitted the most powerful forces in American finance against a president who was willing to burn it all down. Let's go back to the very beginning. In 1791, barely 2 years after the Constitution was ratified, Treasury Secretary Alexander Hamilton proposed the creation of a national bank, the first bank of the United States. Hamilton was a visionary, and he understood something that most of his contemporaries didn't. A new nation needed a stable financial system. It needed a central institution that could regulate credit, manage the government's money, issue a uniform currency, and keep the wildly irresponsible state-chartered banks in check. Thomas Jefferson hated the idea. He saw the bank as a dangerous concentration of power, a gift to wealthy northern financiers at the expense of southern farmers and ordinary citizens. But Hamilton won the argument, and the first bank was chartered for 20 years. The bank did exactly what Hamilton promised. It created order. It kept inflation in check. It forced state banks to be more responsible with their lending. But the same people who feared centralized power never stopped fighting it. When the bank's charter came up for renewal in 1811, Jeffersonian Republicans in Congress refused to extend it. The first bank of the United States died quietly, and the consequences were felt almost immediately. Without a national bank disciplining the state banks, the number of state-chartered banks exploded. These banks issued their own banknotes freely, and with no federal authority to restrain them, they printed far more paper than they had gold or silver to back it up. During the War of 1812, coins became so scarce that most banks simply stopped redeeming their notes for hard money altogether. Instead of pulling back, they printed even more. Inflation surged. The economy lurched from one crisis to the next. By 1816, the chaos was so severe that Congress chartered a second bank of the United States, this time with a 20-year mandate. The second bank was bigger, more powerful, and more ambitious than the first. It held the federal government's deposits. It issued a national currency that was accepted everywhere. And crucially, it acted as a regulator, forcing state banks to limit their note issuance to what they could actually redeem in gold and silver. For a while, it worked. The American financial system stabilized. Credit flowed more responsibly. The currency held its value. But the second bank also made enemies, and its most dangerous enemy was a man who would go on to reshape the American presidency itself. Andrew Jackson was a war hero, a populist, and a man who carried grudges like other people carry pocket watches. Earlier in his life, Jackson had been burned badly by financial speculation and the sudden tightening of bank credit. He never forgot that experience. To Jackson, banks were instruments of corruption, tools used by wealthy elites to squeeze ordinary people. And the second bank of the United States, in Jackson's view, was the most dangerous bank of all, a monster that concentrated too much economic power in the hands of a small circle of privileged men who answered to no one. When Jackson won the presidency in 1828, the bank war began almost immediately. The president of the second bank was Nicholas Pitt, a brilliant and cultured Philadelphia aristocrat who had turned the institution into one of the most powerful financial entities on earth. Pitt was a shrewd operator. He used the bank's enormous resources to influence politicians, fund friendly newspapers, and build a network of allies in Congress. Between 1830 and 1832 alone, the bank spent somewhere between $50,000 and $100,000 printing and distributing pro-bank propaganda. And it lent roughly $100,000 to sympathetic newspaper editors and perhaps as much as $200,000 to congressmen. It was an extraordinary exercise of financial power deployed directly into the political arena. Pitt's allies in Congress, led by Senator Henry Clay and Daniel Webster, decided to force Jackson's hand by pushing through a Recharter bill 4 years early in 1832, hoping to turn the bank into a campaign issue that would embarrass the president. They miscalculated badly. Jackson vetoed the Recharter with a message that still ranks among the most powerful presidential statements in American history. He didn't just argue that the bank was unconstitutional. He framed it as a fight between the people and the privileged few, between democratic self-governance and the tyranny of concentrated wealth. The veto electrified the nation. Jackson won re-election in a landslide, and he immediately escalated the war. He ordered the removal of all federal deposits from the second bank and redistributed them to a network of politically friendly state banks, which his critics derisively called pet banks. Pitt, in a desperate counter-move, began restricting credit across the country, deliberately engineering a financial squeeze in an attempt to force Congress to overrule Jackson. Businesses failed. Workers lost their jobs. Credit dried up overnight. Pitt believed the pain would turn the public against the president. He was wrong. The public turned against Pitt instead, horrified that one unelected banker could hold the entire national economy hostage. The charter of the Second Bank of the United States expired in 1836, and with it died the last institution standing between the American money supply and total chaos. Jackson had won his war. He had slain the monster. But what he left behind was a power vacuum that would swallow the American economy whole. What came next was the era that historians now call the free banking period. And it was by almost any measure one of the most extraordinary and terrifying experiments in the history of money. With the second bank dead and buried, there was no longer any federal authority regulating banks, controlling the money supply, or overseeing the issuance of currency. Banking was left entirely to the states, and the states, for the most part, were happy to let almost anyone who wanted to open a bank do exactly that. The logic behind free banking sounded reasonable on paper. Instead of requiring a special act of the state legislature to obtain a bank charter, which was a process riddled with corruption and political favoritism, states like Michigan, New York, and eventually more than a dozen others passed laws that allowed virtually anyone who met minimal capital requirements to start a bank. The idea was that competition would keep banks honest. The market, so the theory went, would discipline bad actors more efficiently than any government regulator ever could. The reality was very different. Under these new laws, banks sprang up like weeds after a rainstorm. In state after state, Men with little banking experience and even less capital rushed to open banks because opening a bank in antebellum, America was quite literally a license to print money. And that is not a metaphor. Every state-chartered bank could issue its own banknotes, paper currency backed, in theory by deposits of gold, silver, or state bonds held in the bank's vault. These banknotes were supposed to function as money. You could use them to buy goods, pay debts, and settle transactions. But the system had a fatal flaw built right into its foundation. There was no uniformity, no standardization, no national authority, ensuring that the notes were worth what they claimed to be worth. A $5 bill from a bank in New York looked nothing like a $5 bill from a bank in Georgia. Each bank designed its own notes with its own engravings, its own signatures, its own paper. The result was a monetary landscape of staggering complexity. By the eve of the Civil War, roughly 9,600 private banks had issued an estimated 7,000 varieties of banknotes into circulation. Every one of them looked different. Every one of them had a different claim to value. And the value of any given note depended not just on the bank that issued it, but on how far away you were from that bank when you tried to spend it. This is where things got truly insane. A banknote issued by a reputable bank in Boston might trade at full face value in Boston, but if you carried it to Philadelphia, it might only be worth 95 cents on the dollar. Take it to Cincinnati, and it might be worth 80 cents. Take it to some frontier town in Illinois, and the shopkeeper might not accept it at all. Because who was this bank in Boston? How would a general store owner in the middle of Illinois ever verify that the bank was real? That it actually had gold in its vault? That the note wasn't printed by a con artist in a basement? The honest answer is he couldn't. This created an entire secondary industry. Businesses and banks published what were called banknote reporters and counterfeit detectors. Essentially thick weekly or monthly pamphlets that listed every known banknote in circulation along with its current value and whether the issuing bank was still solvent. These guides were indispensable. Merchants kept them under their counters the way a modern bartender might keep a list of accepted credit cards. Before accepting any piece of paper currency, you had to flip through pages of tiny print to determine whether the bank that printed it was legitimate, whether the note was trading at a discount, and whether it matched the description of a known counterfeit. Even for an experienced merchant, making change was an exercise in applied forensics. And counterfeiting was absolutely rampant. With thousands of different banknotes in circulation, each with its own unique design, forgers had an almost unlimited field of opportunity. Estimates from the period suggest that approximately 1/3 of all paper money in the United States during the free banking era was counterfeit. Some historians have put the number even higher. Counterfeit detectors listed hundreds, sometimes thousands of known fakes, but the counterfeits were always a step ahead. They would copy designs from obscure banks in distant states, knowing that no one in the local market would be familiar enough with the genuine article to spot the difference. Some forgers didn't even bother copying real notes. They invented entirely fictitious banks, printed beautiful, professional-looking currency in their names, and put the notes into circulation. By the time anyone figured out the bank didn't exist, the forger was long gone. But the most colorful and disturbing characters to emerge from this era were the wildcat bankers. This is where the free banking experiment descended from merely chaotic into genuinely predatory. The term wildcat banking is believed to have originated in Michigan in the 1830s, and the story behind it tells you everything you need to know about the mentality of the era. Here's how a wildcat bank worked. A group of men would obtain a state bank charter, often with minimal capital and minimal scrutiny. They would locate their bank in the most remote, inaccessible place they could find, deep in the woods, across a swamp, on some god-forsaken stretch of frontier, where, as the joke went, only the wildcats roamed. Then they would print a massive quantity of banknotes and distribute them as widely as possible. They would use the notes to buy goods, pay debts, and make loans. The notes would circulate from hand to hand, spreading outward from the bank like ripples in a pond. And here's the key. If anyone ever tried to redeem those notes for actual gold or silver, they would have to physically travel to the bank's office, which was deliberately located in the middle of nowhere. Most people never made the trip. And if someone actually did manage to find the place, the bank would often be closed, or the officers would be conveniently absent, or they would claim the gold was temporarily unavailable. Sometimes the bank would literally move to a different remote location overnight. The wildcat bankers were in essence running an elaborate confidence scheme. They were printing money, spending it, and betting that the notes would never come home to roost. And for many of them, the bet paid off handsomely, at least until the music stopped. Michigan provides perhaps the most notorious case study. The state passed one of the first free banking laws in 1837, and within 2 years, the results were catastrophic. Banks sprang up across the state at a furious pace, many of them little more than storefronts with a printing press in the back room. State inspectors were supposed to verify that each bank held adequate reserves of gold and silver. But the wildcat bankers quickly found ways to game the system. In one legendary scheme, bankers would physically move the same crate of gold coins from bank to bank, staying one step ahead of the inspectors. By the time the inspector arrived at one bank and opened the vault, the gold was already on its way to the next one in a horse-drawn wagon. The inspectors would check the books, see the gold, confirm that everything was in order, and move on, never realizing they were counting the same coins over and over again. By 1899, Michigan's banking system had completely collapsed. Most of the state's free banks had failed, taking their depositors' savings with them. The notes they had issued were worthless. The entire state's economy was devastated, and Michigan was not alone. The Panic of 1837, which erupted just months after Jackson's pet banks began receiving federal deposits, was one of the worst financial crises in American history up to that point. Banks across the country suspended payments in gold and silver. Credit froze. Businesses failed by the thousands. Unemployment surged. The depression that followed lasted into the mid-1840s, and its scars marked an entire generation. Several factors contributed to the panic, including Jackson's Specie Circular, an executive order requiring that payments for public land be made exclusively in gold or silver, which drained hard money from the banking system, just as the pet banks were extending reckless amounts of credit. But the underlying cause was structural. Without a central bank to manage the money supply and enforce discipline on the state banks, the entire system was a house of cards waiting for a strong wind. What's remarkable and in many ways disturbing is that even after the devastation of the Panic of 1837, the free banking system continued largely unchanged for another quarter century. State after state continued to pass free banking laws. Banks continued to proliferate. Notes continued to multiply. Counterfeiting continued to flourish. And periodically, the whole thing would blow up again. The Panic of 1857 was another brutal convulsion, wiping out banks across the frontier, devastating communities, and reminding everyone just how fragile the system really was. But beyond the panics and the wildcat schemes, there was a deeper, more insidious cost to the free banking era. One that is harder to measure, but arguably more important. The absence of a uniform currency was strangling American commerce. Doing business across state lines was an exercise in frustration and suspicion. Every transaction required a mental calculation about the quality of the money being offered. Merchants discounted out-of-state notes, sometimes by 5 or 10 or 20%, which meant that a dollar earned in one state might be worth 80 cents in the next. This friction added costs to every level of the economy. It slowed trade. It discouraged investment. It made the simple act of buying and selling goods unnecessarily complicated and risky. And it was profoundly unfair. The people who suffered most from the system were not the wealthy financiers or the well-connected merchants who understood the intricacies of banknote valuation. It was the ordinary people, the farmers, the laborers, the shopkeepers, the people who had no choice but to accept whatever currency was offered to them and hope for the best. When a wildcat bank collapsed, it wasn't the bank's owners who bore the cost. They had already spent the notes and moved on. It was the small farmer holding a handful of worthless paper or the widow who had deposited her life savings in an institution that existed only to enrich its founders. But it wasn't just individual banks that caused chaos. The system itself created perverse incentives at every level. State legislators had every reason to charter as many banks as possible because more banks meant more lending, more economic activity, and more political donations. Bank owners had every incentive to issue as many notes as possible because each note represented a loan to the public on which the bank earned interest. And there was no federal authority with the power or the will to say no. Some states tried to impose order. New York, for example, passed a relatively strict free banking law in 1838 that required banks to back their notes with deposits of state bonds and created a safety fund to protect note holders. The system worked reasonably well in New York, where regulators were relatively diligent, and the bond market was deep enough to provide genuine security. But most other states lacked New York's regulatory infrastructure, and many of them adopted free banking laws with minimal safeguards and virtually no enforcement. The result was a patchwork of wildly inconsistent regulations, where the safety of your money depended entirely on which state you happened to live in. At the other extreme, some states were so burned by the banking disasters of the 1830s that they banned banking altogether. Arkansas and Iowa, traumatized by the collapse of their banks, simply prohibited the chartering of any banks at all for extended periods. These states operated without any banking institutions, which created its own set of problems as businesses and individuals had no access to credit and had to rely entirely on hard money or notes issued by banks and neighboring states. And then came the war. By 1861, the United States was tearing itself apart. The secession of the southern states and the outbreak of the Civil War created a financial crisis of unprecedented proportions. The Union government needed money, and it needed it fast. The cost of the war was staggering, far beyond what anyone had anticipated. Federal spending exploded from a pre-war surplus of around $5.6 million to deficits of hundreds of millions of dollars per year. Taxes were raised dramatically, including the introduction of the first federal income tax in American history. But even the new revenue streams were nowhere near sufficient to fund the war effort. The Union's Treasury Secretary was Salmon P. Chase, a former senator and governor of Ohio who was as ambitious as he was capable. Chase faced an impossible situation. The treasury was nearly empty. The banks had suspended specie payments in December of 1861, refusing to redeem their notes for gold or silver. The government's credit was shaky at best, and the financial markets were deeply skeptical about the Union's ability to win the war. Chase needed a revolutionary solution, and he found two of them. The first was the greenback. In February of 1862, Congress passed the Legal Tender Act, authorizing the Treasury to print $150 million in United States notes, paper currency backed by nothing but the credit of the federal government. These notes were printed with distinctive green ink on the reverse side, which gave them their iconic nickname. For the first time since the disastrous continental currency of the Revolutionary War, the federal government was directly issuing paper money. Two subsequent acts raised the total authorized amount to $450 million. And by 1864, roughly $415 million worth of greenbacks were circulating through the economy, ultimately financing about 15% of the Union's total war costs. The greenbacks were controversial. Hard money advocates denounced them as inflationary and unconstitutional. Their value fluctuated with the Union's military fortunes, sometimes trading at significant discounts to gold. But they served their immediate purpose, providing the government with a flexible source of funding at a moment of existential crisis. Chase's second innovation was even more consequential in the long run. It was the National Banking Act, and it would fundamentally transform the American financial system in ways that are still felt today. The idea behind the National Banking Act was elegantly simple, even if the politics of passing it were anything but. Chase, working closely with Senator John Sherman of Ohio, proposed a system of nationally chartered banks that would be required to purchase federal government bonds as a condition of their charter. These bonds would then serve as backing for a new uniform national currency, printed by the government, but issued through the national banks. The system served two purposes simultaneously. It created a market for government bonds, which helped finance the war, and it established a standardized national currency, ending the chaos of the free banking era in one legislative stroke. The opposition was fierce. Congressman Thaddeus Stevens of Pennsylvania argued passionately that banking should remain a state matter, and he was far from alone. State-chartered banks had no desire to submit to federal regulation or give up the profitable privilege of printing their own notes. The bill passed on February 25, 1863 by the razor-thin margin of 23 to 21. President Abraham Lincoln signed it into law, but the original act wasn't enough to kill the state banknotes. Even though the National Banking Act imposed a 2% annual tax on state banknotes, the tax was too small to make private note issuance unprofitable. State banks continued printing their own money alongside the new national currency. The cacophony of competing notes actually got worse for a time, not better, as greenbacks, national banknotes, and state banknotes all circulated simultaneously, creating an even more confusing monetary landscape than before. It wasn't until 1865 that Congress delivered the killing blow. A revised act raised the tax on state banknotes from 2% to 10%, a rate so punishingly high that it made issuing state notes economically suicidal. Within months, state banknotes began disappearing from circulation. By 1866, they were effectively extinct. The era of private money creation in America was over. The transformation was stunning. Almost overnight, the American monetary system went from one of the most chaotic and fragmented in the developed world to one of the most uniform. The national bank notes looked virtually identical, differing only in the name of the issuing bank and signatures of its officers. For the first time, $1 in Maine was unquestionably worth $1 in California. Merchants no longer needed counterfeit detectors to make change. Farmers no longer had to worry that the notes in their wallets might be worthless by morning. The simple taken for granted act of trusting a piece of paper currency, something that billions of people do every day without a second thought, was made possible by this moment. But the victory came at a cost that is worth acknowledging. The National Banking Act didn't just create a uniform currency. It also created a system that was designed from the ground up to serve the financial interests of the federal government. The requirement that national banks purchase government bonds as a condition of issuing currency meant that the banks were in effect forced to lend money to the government. This guaranteed a market for federal debt, which was essential for financing the war. But it also tied the money supply to the government's borrowing needs, in ways that would create new problems in the decades ahead. The amount of currency in circulation was determined not by the needs of the economy, but by the supply of government bonds available for purchase. When the government ran surpluses and retired its debt, the money supply contracted, sometimes painfully. This inflexibility would contribute to a series of financial crises in the late 19th century, eventually leading to the creation of the Federal Reserve System in 1913. Yet another attempt to solve the riddle of who should control America's money. And there's a deeper lesson here, one that goes beyond the mechanics of banking regulation and monetary policy. The free banking era was at its core an experiment in radical decentralization. It was an attempt to let the market solve the problem of money, to let private actors compete to provide the best and most trusted currency. The experiment failed, not because competition is inherently bad, but because money is fundamentally different from other goods. Money is a shared social technology. Its value depends entirely on trust, and trust requires some form of collective guarantee. When that guarantee was absent, as it was during the free banking era, the result was not efficient competition. It was chaos, fraud, and suffering borne disproportionately by the people who could least afford it. The parallels to our own time are hard to ignore. In recent years, the rise of cryptocurrencies has reignited many of the same debates that animated the free banking era. Proponents of crypto argue that decentralized, privately issued digital currencies can compete with government-issued money, freeing the financial system from the control of central banks and returning monetary power to the people. Critics warn that the result will be the same as it was in the 1840s. A proliferation of competing currencies of uncertain value, rampant fraud, and ordinary people left holding worthless tokens when the music stops. The technology has changed. The fundamental questions have not. What happened in America between 1830 and 1863 is not just a quirky footnote in financial history. It is a cautionary tale about what happens when the power to create money is left in private hands without adequate oversight. It is a reminder that the dollar in your pocket, the one you can spend anywhere in the country without a moment's hesitation, is not a natural fact of the universe. It is a political achievement, won through decades of crisis, corruption, war, and hard-fought legislative compromise. Every time you hand a bill to a cashier and they accept it without question, you are witnessing the legacy of a system that was built on the ruins of one of the most chaotic monetary experiments in modern history. The men who ran the wildcat banks are long dead. Their worthless notes or collector's items now displayed in museums behind glass. But the questions they raised about who should control the money supply, about the relationship between private capital and public trust, about whether the market can be relied upon to police itself, these questions are alive and well. They are being debated in Congress, in regulatory agencies, in boardrooms, and on trading floors right now, as new forms of money and new financial technologies challenge the assumptions that have governed our monetary system for more than a century and a half. So the next time you looked at a dollar bill, take a moment to appreciate the sheer improbability of what it represents. A piece of paper backed by nothing but collective trust, accepted by 330 million people without a second thought. There was a time in this country when that kind of a trust didn't exist, when money was whatever the nearest bank said it was, and when the nearest bank might be a shack in a swamp run by a man with a printing press and a one-way ticket out of town. It took a war, a revolution in financial law, and the collective exhaustion of a nation drowning in worthless paper to change that. And if history teaches us anything, it's that the fight over who controls the money is never really over. It just changes form. If you found this story fascinating, make sure to like this video and subscribe to the channel. We cover these kinds of deep dives into the hidden machinery of money, power, and the systems that shape our world every single week. Hit that notification bell so you don't miss the next one.